So hi everyone, it's Wisdom Jordan right back here, and in this lesson we shall be looking at the Bollinger Bands. So the Bollinger Bands are the most common volatility indicator known to forex trading, and at least each and every person who trades forex, stocks, or cryptocurrency knows about the Bollinger Bands. Okay, so in this video we are going to be looking at these Bollinger Bands. Okay, so the image here is what shows you how the Bollinger Band looks like. They have an upper band, they have a middle line, and then they have what we call the lower band. So this line up, this one here is called the upper band, then this one is called the middle line, and then this down one is called the what? The lower band. Okay. So the Bollinger Bands, they were developed majorly for generating oversold and then overbought signals. So they have three lines that compose of the linear bands. We have a simple moving average, that is a middle line, and the upper and a lower band. So this is a simple moving average right in the middle. This is the upper band, then the down one is the lower band. So the upper and lower bands are typically two standard deviations, either plus or minus from the 20-day simple moving average, which is a center line, but they can be modified according to your setting preferences. So do not mind that one so much, it doesn't matter. So when a price continually touches the upper Bollinger Band, it can indicate an overbought signal, while continually touching a lower band indicates an oversold signal. So we all know that every time the price is dropping down, we have been selling. That is because of selling pressure. And when the price starts to move up, that is because of what? Buying pressure. The price is moving down, that is selling pressure. So every time the price drops, it reaches a stage where it is where traders say that it is oversold. So they expect a reversal. And when the price reaches the tip or the top, that is when they say that the price is overbought. That's when they expect a reversal to a bear trend. Okay. So, but in currencies, overbought, oversold idea, I basically do not buy it. So Bollinger Bands are used to measure the market volatility. So when the bands are widely apart, it shows higher volatility within the market and vice versa. So every time you say that, for example, here, when you look here, the bands are not widely apart. So this is lower volatility. And then when you look right here, the bands are widely apart. That shows higher volatility. So when you look right here, they are a little, they are little wider, and then that can show us some sort of let's say moderate volatility. Okay, so when the bands are widely apart, it shows high volatility, and when they are not widely apart or they are narrowly apart from each other, it shows a lower volatility within the market. Okay, so I want you to note the best uses of this indicator is to measure market volatility. That is number one. So to determine the overbought and oversold condition of a given market. And then Bollinger Bands can act as dynamic support and resistance. Okay. They act as dynamic support and resistance, especially in a ranging market. So they can also be used to show what we call the consolidations or the sideways market. And this happens on what traders call the squeeze. Okay. So this occurs when the upper band and the lower band are next to each other, and this can provide some breakout trading entries. We shall look at that more in our strategies. Okay, so we are going to jump onto live chat, and then we see a Bollinger Band, how to set them, and how to modify the settings. It is, and then we shall be seeing where we can take trades from and where we cannot take trades from. Okay, so we are on a live chat. Okay, so as everyone can see that this is the gold dollar right here. This is a gold dollar pair, and we are using the daily time frame. This is the D1. This is the daily time frame. So every candle you see on the chart represents one full day of trading. Okay, so this is gold. Okay, we can use any other, but let's use this gold. So when you want to put in your Bollinger Band, once again you come to this indicator here. Sorry, to this icon right here in MetaTrader 4 or MetaTrader 5. So that is the icon for indicators. Okay, so you come, you click on it, and then you go to oscillators. So it is under trend, that is under trend indicators. That's why you get your Bollinger Bands. You click on it. So here you get a pop-up box for settings. So we leave it at a period of 20. That's the default settings. Then you have a standard deviation of 2. We apply the price to close. There is open, high, low, median, what, but to apply it to close, that is always best. And then would not shift it to anything. So if then levels, you can add in some levels, but they're not necessary. Then visualization is set to all time frame, and then you click OK. So when you click OK, you get your Bollinger Band. Let me try to change the color so that it becomes a little better. White, but yellow. Okay. Yellow is yellow. Okay. Okay, let me get a better color. Aqua. I think this is more visible to majority of people. Increase on the size at least 2. Okay. So we look at the chart. This is the Bollinger Band. Okay. Right here, this is the upper band, and then this is what we call the lower band. So we said when the bands, the upper band and lower band, are widely apart, it shows that there is high volatility, and the vice versa. So for example, here there is high volatility right here because the lower band and the upper band are widely apart. Then right here, the volatility also increased. So when you look here, this is what we call, this is where there was low volatility around here. So if there was low volatility, there is the lower band and the upper band, they tend to squeeze each other. So, and after they have squeezed each other, we normally expect a breakout of this squeeze when the bands start to widen once again. So we can try to move back into the history and then see. So for example, here, we can see that here there is high volatility, okay? Here there is low volatility, and then here there is high volatility, like that, okay? So we shall try, let's try to change a pair and then go to euro dollar, okay? So euro dollar, want to insert in the Bollinger Band, so trend, then insert in the Bollinger Band. Okay, so right here we have the Bollinger Band, okay? So I want you to note one thing, that this is how we trade the Bollinger Band. We use it in conjunction with other indicators. Every time the price hits the lower Bollinger Band, there is always a time for it to reverse and then move upward. It means that every time the price hits this lower band right here, and then price comes, hits, price moves, hits the lower Bollinger Band, there is always a chance of it reversing. That is when traders expect what? A bounce off of the Bollinger Band, lower band, okay? So when the price moves upwards again, it hits this level upper band, it will drop back again. That's what the traders anticipate in most cases. So the price has hit here, for example, the lower Bollinger Band, and then we get a very good candlestick pattern right here. It's a big bullish candle, so we expect the price to move upward once again, and then it did, went up like that. So every time the price hits the lower Bollinger Band, it moves up. So every time the price hits the lower Bollinger Band, it means that the price is overbought. And when the price hits the high upper Bollinger Band, it means that the price has been overbought. Okay. So when price hits the lower Bollinger Band, it is oversold. Higher Bollinger Band, it is overbought. So every time you have your Bollinger Bands like that, okay. So, and then the price is moving, hits the upper Bollinger Band, then it will come back, hit the lower Bollinger Band, okay, bounce off, move again. It can come back and hit it again and then bounce off, and then it continues in a new trend, okay? So that is what we are trying to anticipate right here on the chart. So for example, here it worked, and here worked, then here it did not reach the lower band because it is in this trend here, which was tried to be formed right there, okay? So I want you to note one thing, that not all the time it works, okay? So when the price hits a lower Bollinger Band, you expect to buy, but it has to work in conjunction with other indicators. So for example, you can use other indicators that we shall be looking at, for example, the MACD, moving average divergence, the parabolic SAR, the force index, the stochastics, etc. So it means that the price is moving down, and then it reached a stage whereby it was oversold. So when the price reached a level whereby it was oversold, we expect a reversal. But for us to anticipate this reversal, we need to get confluence. We need to get an indicator, for example, another indicator like the MACD, to show us the same signal. So after that, we need to also get a candlestick pattern. For example, here, we can see that we got a bullish engulfing pattern, right? This one here. It's a beautiful bullish engulfing pattern because this candle covers this entire, the body of this entire previous candle. And then that is when we get this new buy signal, okay? So, for example, now when you look here, this is a daily candle. So these are daily candles, this is your USD, and here the price has hit the upper Bollinger Band twice. Okay, so here we anticipate that the price is over overbought, and then we are expecting at least a big retracement or a change in trend. So it means that all the time we are going to be looking at forming a new trend. For example, it's a downtrend, or we shall form a consolidation a bit and then break into into another uptrend, or we can reverse and then form a new trend, which is a downtrend. Okay, but according to how the Bollinger Band looks like, I am anticipating a consolidation because we are saying that this upper band and this lower band are trying to squeeze up each other. So it might squeeze up for some small days because of daily candles, and then after there it will break and form a new trend, either downward or it will either continue into the uptrend. Okay, so you have to just keep it under a watch list. So when you move back into history, we want to see how often does this work or how often it doesn't work. Okay, so for example here, when you look here, we are looking to get buy signals when the price hits the lower Bollinger Band, for example here, and then we get a candlestick pattern. Okay, and then we are moving into conjunction with another indicator. For example, let's say here that the MACD has a positive signal, then we put our buy order right there up, put our stop loss. We say the stop losses are placed using this ATR indicator right here. So the ATR is reading 88 today, but this is not the candle. So we need to find out the ATR of the previous time and then of the current time. So for example, if you're here and then you put a stop loss at 1.5 of the ATR and then you measure at least 3 times of the ATR, you would have collected some money. So here the price hit. Okay, so for example, you're putting a sell order right there. So here it hits the upper Bollinger Band. Okay, but there is no candlestick pattern. So this is not a candlestick pattern right there. Okay, but when you see these 3 candles right here, those 3 candles, those are 3 white soldiers. Okay, sorry, they're not called 3 white soldiers, called 3 black crows. 1, 2, then 3. Those are 3 bear candles in a row, and those are called the black crows. If you didn't watch that video about you didn't watch that video about candlestick patterns, you've got to go back and watch them and then come back and then get what we're talking about. So right here we had to put a sell limit order, sorry, a sell stop order, sell limit. We had to put here a sell stop order. Then we have to put the stop loss at around here at 1.5 the ATR, and then we target at least 3 ATR downwards, or at the when the price hits this lower band, because this is a Bollinger Band, then we can be able to grab some profits. But when you look at here at this level here, the price did not trigger us because it need to move away, and we used a limit order. So putting a limit order right here, the price did not trigger us. So the market made another retracement upward. So anticipating to create what we call a double top, like here. So this could have been a potential double top, and then it formed a new after retesting this level. Okay, it formed a bearish engulfing pattern, this one here, and then you can put here your order once again, put a stop loss 1.5 of the ATR, then you can be able to catch the wave down. Okay, so for example, now we come back here, price hits lower Bollinger Band. Is there a candlestick pattern? Yes, we have 3 white soldiers. Is everyone seeing this? These are the 3 white soldiers. Okay, those 3 these 3 consecutive green candles are the ones we call the white soldiers. So you put here your buy stop order, put a stop loss around here. This is 1.5 ATR, and then you collect 3 times, or when the price hits the upper Bollinger Band. Okay, so you put your take profit. So once again, here the price hit the upper Bollinger Band. No, do we buy? Sorry, do we sell? Or no, we do not sell, and then we leave the signal to pass. Or sometimes we can anticipate something else. For example, this was a level of resistance, and the price was bouncing off that level of resistance. Okay, so we got that one. So for example, when you look here, the price hits the lower Bollinger Band very clearly, and then it creates a candlestick pattern. After creating candlestick pattern, then we target and then wait for the price to come and take our hit our take profit. Okay, so that is simply how we trade with the Bollinger Bands. So, but it does not work all the time, and it is supposed to be used in conjunction with other indicators. So move back into history once again. I want to show you something. So for example, here, this is what we call the squeeze. So here, the price created a clear major downtrend. Okay, so after clear major downtrend, in most cases, you can see a smooth consolidation, either to break up or to break down. Okay, according to chart patterns, and that video is going to be made very soon. So this is how the price moved downwards. Then after there, it created a short-term consolidation. Then it broke the consolidation by breaking this squeeze. Okay, this is the candle which broke the squeeze right here. So the squeeze starts from around here and then here. Okay, after creating this squeeze, it broke the squeeze, and then we created that breakout. That is what we call a breakout using the Bollinger Bands. So even here, there was a squeeze. You can see very clearly. And then after that, this candle broke out of the squeeze, and then we created a down trend. So that is how basically we trade with a Bollinger Band. Okay, so you can see that the Bollinger Band normally works best in a consolidation market. Okay, so for example, here the market was trying to consolidate. I don't know if it is in a greater view. You could be able to watch over that. So here the price hits a lower Bollinger Band. We are waiting for a price to reverse and go upward. Upper Bollinger Band, waiting for the price to drop once again. So this is how we use the Bollinger Band. So number one, I want you to note one thing, that it does not work all the time. For example, here it hits and then it came back and then mitigated your losses and then it continued in the way you wanted it to go. But here you would have gotten it right again. Okay, so every time the price hits the lower Bollinger Band, we are waiting to get a buy signal. And every time the price hits the upper Bollinger Band, we are waiting to get a sell signal. Okay, so the higher the time frame, the better the Bollinger Bands work. So here it works better on a daily time frame more than on the H1 time frame and the minute 15 time frame. Okay, so if we hover down to H1, for example, you can see that things work, but the market is so volatile in lower markets. When you look here, you would get a lot of losses in this type of market, and I urge you to avoid it. Okay, so the Bollinger Bands work best at a higher time frame. So for example, here it might have worked, right here it worked, right here it worked, right here it worked, like that, like that. So that's how we use the Bollinger Bands. I'll see you in the next video. Thank you for watching. Okay, so we have said in recap. So in conclusion, we use the Bollinger Band to get buy signals. We get buy signals from lower Bollinger Band. Okay, from lower Bollinger Band. And then we get sell signals. We sell from the upper band. And then we get breakout after a squeeze. We also get a breakout after a squeeze. Breakout after a squeeze. Okay, after a squeeze. That is what we said. Okay, don't want you to forget it. Okay, and it works best in a higher time frame. That one also noted. So that's how we shall be using the Bollinger Band. Okay, so in conclusion, you get buy signals when the price hits the lower Bollinger Band. It means that so every time the price comes downwards and it hits the lower Bollinger Band, it means that the price is oversold, and then we expect it to become into a new trend of buying. So we wait for a buy signal, for example, here, and then we buy. So for example, here, the price has hit the upper Bollinger Band right here, and we are waiting to get a confirmation for a sell signal because the price previously has been overbought. Okay, so we are waiting for the price to reverse and then we get a new downtrend. And we also agree that it does not work all the time because, for example, right here, the price hit it and then it tried to form this black cross right here. These three very successful candles, and then it did not continue downward. Okay, and then we have also said that there is what we call the squeeze, and that is when the bands are squeezing each other, they are so next to each other, and then finally we get a breakout candle. Okay, after getting a breakout candle, the price breaks and then either buys or it can also break out to downwards. Okay, so that is where the squeeze happens. Squeeze is when the price is locked into this consolidation, then it can break down or it can break up. So thank you so much for watching this video. I'll see you in the next one. This is Wisdom Jordan. If you've not yet subscribed to the channel, please subscribe because much more is coming. Okay, see you. Bye bye. That's a Bollinger Bands.